And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Ed Butowsky, managing partner at Chapwood Investments with approximately $450 million under management. Ed, welcome to the show.
Well, thanks for having me out.
It's a pleasure. So Ed, I always like to begin. Can you tell us your story and how you got involved in the business?
Well, sure. I started in the business back when it was a time period where I had gotten fired from a previous job. I shouldn't bring that up right away, but I did.
That's a good thing. We all have.
I wanted to do.
Right.
And I decided to interview with Dean Witter at the time, which was then became Morgan Stanley, and got hired on. And I located in Dallas. And I went to the branch manager and I told him if he gave me a chance, I'd be the best broker he ever had.
Nice.
And it turned out to be that when it came to assets under management and long-term relationship, I guess it came out to be the truth, because we got to a point where we're at Morgan Stanley where we had 11 billion under management.
Wow.
At one time. And then when we left Morgan Stanley, we had 4 billion. That was in August of 2002.
Okay.
And then we went to Bank of America. We got bought by Bank of America. When we went there, it was a disaster. It was right after the Glass-Steagall Act had been taken back, and the Graham-Bliley Act was put in place.
Right.
And everybody wanted to get into the investment business. And Bank of America at that time did not have what was set up properly. And they didn't have the infrastructure in place.
Right.
And more importantly, I got sued by Morgan Stanley for $32 million. Wow. For a non-compete. And then when the day came for the trial to begin, because I couldn't talk to my clients for 8 months, when the trial began, they dropped the case. But I went 8 months without talking to any clients. So, and then I left Bank of America pretty quickly and started Chapwood Investments.
Okay. And that's a crazy beginning story, but I love that. It's just like, wow, talk about being blindsided.
Yeah,
wow.
It really was.
So can you tell us a little about your investment strategy?
Yes, what I did a long time ago, it always bothered me when, the idea behind correlations has always stuck with me about, why is it that people continue to put everybody in highly correlated assets and not worry about risk? And I remember a gentleman named Chris Gatesy, who I took classes from at Wharton, who now runs the wealth management program at Wharton. Chris Gatesy and I had a meeting one day with the Alaska Firemen's Association, and it was a discussion about all these terms that I had never heard of before, and I thought, why in the world is he talking about Sharpe ratios and correlations, right, and all these other statistics, and we never talk about that with retail clients,
right? And
it really kind of bugged me. So I set out to really focus in on correlations. And so my portfolios, regardless of what's happening in the market, they're always going to be low correlated assets. And I learned back in 1999 when everybody wanted to be in large cap growth. And I finally, succumbed to it, because in 1997, I said, no way, we're not going to do that. Right. 1998, we're not going to do that. And then finally, I just said, let's just do it. And then all of a sudden, everything turned to what.
Right.
So I made a promise to myself and to clients that I would never go into following the herd mentality. I was always going to have some investments that weren't doing well in their portfolio, because if everything goes up based on a positive economic condition, as soon as that positive economic condition changes, everything goes down.
Yeah.
So so I actually created some metrics of my own. That I do at Chapwood Investments, if you'd like to hear about them.
Yeah, please. That's my next question. So please, would you mind sharing?
Yeah. So yeah, we didn't even have this scripted, Adam.
Right. No, first time we meet, first time we speak. So thank you for all this information.
So I realized that sometimes people get clients based on their personalities and based on who else they have as a client. And that's not a good way. I mean, I've had many referrals from people saying, I want you to work with this guy because he has this person as a client, or he has this many assets under management. And that's not the correct way for somebody to select a financial advisor.
Right.
So I created these 8 metrics, and they're on my homepage at chapwoodinvestments.com. And the 8 metrics are: what rate of return do you need to make in order to not lose purchasing power after subtracting taxes and your cost of living increase? Because people do not accurately reflect what the real cost of living increase is. The CPI is a bogus statistic, has no relevance, no purpose in life, quite frankly.
Yeah, I agree.
And so then the next one is, what standard deviation do you have? And I created my own term called variance drag phantom tax. And that simply is taking your standard deviation and dividing it into your rate of return. And you want that number to be 0.8 or lower. So I can look at a portfolio, and I always look at a 7 to 10 year time horizons and determine if it's accurate or not, or if it's a good portfolio, and I call it an efficient portfolio, by simply looking and seeing if your variance drag phantom tax, your VDPT, is 0.8 or lower. Then we look at your Sharpe ratio, which is a very well-known term in our industry. Then I'm able to calculate the probability of any loss in the next 12 months. People want to know, what is the probability of any loss? And people would be shocked looking at a highly correlated portfolio, what the probability is. It's about 32% in most retail portfolios. And then the amount of money at risk. So if you had $1 million portfolio, how much money is at risk based on historical data? And you'd be shocked at that. Then we look at the correlation of the S&P 500 to the overall portfolio. And we also look at the range of returns, the probability of making plus 40% versus minus 20 while averaging 10%. People want to know, and you want that number or that range to be as narrow as possible. If you're going to average a 10% rate of return, you'd like it to be positive 22 versus minus 2 on the negative side with a 95% probability. And those are the 8 metrics that I've created and that I analyze portfolios to determine. And most portfolios, Adam, do not measure up. In fact, 97.5% of all retail portfolios are inefficient.
Okay, Ed, that is absolutely brilliant. It's fantastic. So I just want to slow down in case the audience is listening and they're not following 100% with what you're saying, and unpack some of that. Let's start with correlations. So with highly correlated assets, in other words, if I put all my money into 10 big tech stocks and tech stocks are out of favor, they're highly correlated, most likely they're going to go down. But a non-correlated way of doing that, if I understand you correctly, would be buy a little bit of tech, buy a little bit of industrials, buy a little bit of utilities, and so on and so forth, or maybe some gold or some non-correlated investments. And this way the assets are not correlated. Is that correct, or do you have something else there?
That is correct. And you can look at, there's many different ways to get into alternative investments through ETFs. So if you don't have a big portfolio and you can't go with hedge fund managers because of the minimums, you can gain access through exchange traded funds. But everybody should be looking to get low correlated assets into their portfolio, because if everything goes up together, the moment that economic condition changes, everything will go down together. And that's a big problem.
That's really, really good. Now I'm curious, did you have a specific incident outside of 99, this last March of 2000 with the dot-com bust, or was it that was the actual catalyst to help you do that?
It really got me, in 1994. I'm old. I've been at this a long time. And in 1994, when we had the Asian contagion, everything went down together. And that's when I really started studying this and really became, what I'd like to call like an investologist. In fact, I put that on my LinkedIn site to have people ask what an investologist is. And I study the efficiencies of portfolios.
I love that.
Most portfolios are terribly inefficient, meaning that everything goes up and down together. And right now, during a boom time, everybody's happy with their financial advisor. That's why I'm having a hard time getting new business from people.
Right.
But the moment it changes, that's when I'm going to get their clients.
No, that's 100%. It's just a cycle, right? It repeats over and over again.
That's right.
So, okay, the next question. Can you go through your 8 points again, just one by one? What's the first point?
The rate of return that you need to make in order to not lose purchasing power.
Okay.
And that after subtracting taxes, your investment expenses, and your cost of living increase.
Got it. So the cost of, how do you know what that is? In other words, the average person would need, let's say, $5,000 a month. So you'd have to reverse engineer it, or $10,000 a month, or whatever the number is, it doesn't matter. Is that how you do it, or do you have a different way of calculating it?
Well, no, we take $5,000 a month, and then we add to it usually about 6% a year. So the next year, that person would need $5,300.
Got it.
To
okay.
stay even with what they needed the year before.
So you'd put some income producing assets into the portfolio that are non-correlated to the other ones to make sure the investor in that situation would get at least the 5,000 adjusted for inflation or 6% higher every year.
That's right.
Correct. Okay.
It's a very, very tough thing to do, Adam.
Exactly. Hence the questions, right? I just want to make sure they understand it.
Yeah.
And what's the second one?
Second one is standard deviation.
Okay.
And that's a statistical term of volatility. So every investment and every portfolio has a standard deviation that is calculated for you. So anybody who's looking at an investment should ask for the standard deviation of their portfolio and should know that they should look at it over a 10-year time horizon. Right. A 2-year time horizon does not accurately reflect the standard deviation.
Right. So a standard deviation, if for volatility, meaning if the account value is at 1 million and all of a sudden it goes 1.5 million, the next day it's at 700,000, I'm exaggerating, that would have an extremely high standard deviation because of the fact you get these massive swings.
That's correct. Right. Like Bitcoin, which everyone talks about right now, has a tremendously high standard deviation.
Got it.
So does gold, so does oil.
Got it. What's the third one?
Third one is variance drag phantom tax. Now, this is something that I made up because it's very similar to Sharpe ratio, but it isn't Sharpe. And I wanted it to be very easy to be able to look at a portfolio and say, here's my historical return. Here's the historical standard deviation. Is this good or not?
Okay.
And by dividing your standard deviation into your rate of return, if you get to be 0.8 or lower, that's acceptable. That's a good portfolio. But most portfolios, most retail portfolios, they have a variance drag phantom tax of 1.5 or higher.
Oh, wow.
So you'll find the S&P 500 has a historical rate of return of about 8% with a standard deviation of 16.
Right.
Which is a 2 variance drag.
Got it. Okay. And then
way too high.
Yeah, way too high. Got it. So basically what you're saying is in bear markets, when the S&P drops 30%, I don't know what happened last March, right? Or whatever the case may be, you have to have money or income or cushion, if you will, or some way of offsetting those massive declines.
That's right. And the way to do that is to have other investments that can go up when others go down.
The non-correlated part, which was the first point. That's excellent. And then the Sharpe ratio, if you want to touch on that, please, since we just discussed
Sharpe ratio, William Sharpe won a Nobel Prize in 1990 for this third of modern portfolio theory. And that is taking your rate of return, subtracting your risk-free rate of return, which is money market, divided by your standard deviation. And and you want that number to be 1 or higher. The problem I have with that statistic is that you could have a rate of return of 4, a money market rate of 2, and a standard deviation of 2, and you'd have a Sharpe of 1, and people would say that's a good portfolio. But who says it's a good portfolio if you have a rate of return of 4?
Right, I fully agree.
You're not even keeping up with your cost of living increase.
Right.
So I'm trying to get my variance drag phantom tax to catch on like Sharpe ratio.
I love that. No, it's actually I know Sharpe for years. I mean decades, but it's a very smart way of adjusting the Sharpe to make it more practical and make it work in layman terms. Because in theory it sounds good. Just like in theory I should do 1,000 sit-ups a day. In practice I'm not doing those sit-ups. So what good is it, right?
You look at me. I'm behind you.
Okay, good. So the next point after the Sharpe
is the amount of money at risk. Excuse me. The next one is the probability of any loss in the next 12 months.
How do you gauge that?
I had it calculated. I had this guy from China who interned for me, and his name is Miao Zhang, and Miao put it together for me, and I know it's correct. I don't know how to calculate these things, but I find really smart people to do it.
That's a smart thing to do, by the way.
It's the probability of any loss in the next 12 months, and we have that on our website under investment forensics. You can go to Portfolio Builder, and people can put in their different investments, and it will solve for that question. It'll solve for all the 8 metrics.
Got it. So it's a theoretical probability-based calculator letting you know approximately how much you could lose in the next 12 months based on the factors?
Over a 12-month period. That's correct.
Got it. Okay, next.
And then the next one is the amount of money at risk. And this is all based on historical data. So we're taking historical data and utilizing the historical data to say, if you believe that we could have any time period similar to what we saw in the previous 12 years, then this is the probability of a loss. This is the amount of money at risk at any one time. So this portfolio historically has seen rates of returns of let's say 7% with a standard deviation of 15, with a probability of a loss of 32%. And if you had $1 million, you would see that it would have maybe $300,000 at risk, because that portfolio actually saw a $300,000 pullback.
Yeah, that's actually that's a really smart way of doing it. So, okay, was that the last one, or do we have one more?
No, we have two more.
Oh, two more. Okay, sorry.
And then we have the historical period of what and the upper and lower return spectrum. So if you had a historical rate of return of 10 and a standard deviation of 15, that means 95% of the time that return was between +40 and -20.
Yep.
So to turn to somebody and say, I have a portfolio that's returned 10% a year, but you have just as good a chance of making 40% as you do losing 20.
Yeah.
Do you want that? Or would you prefer saying, I have a portfolio with a rate of return of 10 and it has just as good a chance of making 26% as it does losing 6? That's a rate of return of 10 and a standard deviation of 8. So you always want to be tracking that standard deviation to make it to be as low as possible.
Got it.
And then the correlation to the S&P 500 is the last statistic that we measure.
Okay. Got it. Yeah, I put correlation at the top. I thought it was number one, but it's at the end. So you look at correlation between assets in the portfolio, and then that's before the process. And then at the very end of the process, you also look at the portfolio based on the correlation with the S&P 500.
That's right.
Oh, wow. Okay. That's excellent.
Yeah, and these are all proprietary tools that we have at chapwoodinvestments.com.
And where does somebody find that list on your website in case they want to go through it?
You go to investment forensics. It's a drop down, and you'll see the metrics there.
Got it. Okay, great. Next, question about risk. So you seem to be a guy who gets it, so to speak. How do you handle risk, and what mistakes do you see people make with respect to risk management?
Well, it goes back to, we tend to have this herd mentality, and people develop amnesia when the markets are going well. Yeah. And that's exactly when it scares me beyond belief. I had this one client named Neil, and every time he would call me and say, get me out of the market, because he was scared, he knew it was time to be in. Right? And then when he would call up and say, it's time to get in, I'm like, oh no, he did everything wrong all the time. Right. But I always have portfolios prepared for anything. Because, I use the analogy of a baseball defense, where you have a left fielder, a center fielder, and a right fielder, and second base, first base, shortstop, third base, and a pitcher and a catcher. And if you were to turn to someone and say, in right field, you didn't get any chances the first 6 innings, so maybe you shouldn't go out for the 7th inning. Right. Well, of course he's going to go out, because you never know when the ball is going to be hit there. Right. So you have to look at every investment as a different opportunity to, and it has different risks associated with it, because you never know when that investment is going to be called on to play. And a bell doesn't go off in the middle of the day and say it's time to switch. So you need to always have every asset base covered, which is going to mean that you're going to underperform when the markets are doing really well. Right. Because you have to have things in there that aren't going to perform well during really strong markets. But
by definition, otherwise it wouldn't be correlated.
That's exactly right. That's why, I always know I'm doing a good job when a client calls and says, everything is going well, but this. I'm thinking, great, that's exactly what I need to hear. Right. Okay. And hopefully, it's not too big of a position that they're unhappy with.
Understood. And then what mistakes do you see people make with respect to risk management?
They think that investing in many different mutual funds that are highly, that are very close together in terms of multiple large cap value funds, multiple mid cap value, small cap value, And they think that there's a huge difference between large cap growth and large cap value. And there really isn't.
No.
These things will all go up and down together. And I also think that people aren't taking advantage of the bond market enough. I heavily invested in single B and double B bonds about a year ago when all of this stuff happened, and picked up a lot of senior rate floating notes, business development companies, and preferreds that were selling at extreme discounts. And we've had a huge return on those. So people not realizing that there is a bond market where you can make money in addition to income. I think that's one of the big problems that people have in investing today.
Understood. Yeah, that's a really good point. So outside of what you've mentioned, or if you want to reiterate, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
I think that most advisors think that they have to be doing something all the time. And some of the best investments are the ones that you just put people in that are good, strong investments that are non-correlated, and leave them alone.
Yeah.
It's almost like a trainer, for me, puts me on a treadmill and then was constantly changing the speed. I'm thinking, you got me on the treadmill. That's you've done your job.
Right.
Leave me alone now.
Right.
And I think too many advisors are feeling a need to switch between like a Facebook and an Amazon or a PayPal, when they're all so highly correlated. Just leave them alone.
Right.
Let the investments work for you. Our overall turnover is less than 5% a year. And I think that that's one of the biggest problems that people make, is they feel as though they need to be doing something all the time. And probably the only other big problem I see for investors are those people who did buy bonds that don't look at the yield to maturity from today. Because interest rates have gone down so much that they should be looking at their yield to maturity calculation right now to determine if their yield to maturity from today is plausible. Because people are going to find out that they're willing to accept a 0.8% yield to maturity. That includes the income, because the price is so high that the price is going to drop down to being at par. So if it's at 105 now, it's going to be at 100, plus you're getting the 3% income. So the combination of those two, in 5 years, you're probably getting a 0.8% rate of return. And that's what advisors need to show their clients, is what that yield to maturity is from today, not when it was when you bought it, or what the income is.
Right. No, that's a really, really good point, Ed. So you bring up a lot of really good points there. Jesse Livermore had a great line. He's like, the big money's made by sitting, right? So just sit, get out of the way. So what are some timeless mistakes you've seen people make outside of just over trading, or if there are any that you haven't covered already, because you've given us so much information, and how do you avoid them?
Well, I would say that not investigating the other types of investments is a problem. There's a lot of great investments out there that you can get into, but putting money into limited partnerships that have long lockup periods are a problem. And there's oftentimes people buy these privately held REITs when they really shouldn't have. I mean, the advisor usually made about 15% commission on those privately held limited partnerships.
Right.
And if you could go into the publicly traded ones and not pay any fee to get in or to get out of them, and get, have the transparency of the SEC oversight, to me, that's a much better way to go. So looking for other investments, but don't go into those long-term limited partnerships. Those are a nightmare for most people.
Got it. Okay. What advice would you give your 30-year-old self?
Cherish my energy. I love this business. I love developing new business, but my energy has dwindled a little bit.
It happens to the best of us.
and I would also say that somebody told me once that, don't mistake a bull market for brains.
Yeah.
And I think that that's really good advice that, I would give my 30-year-old self. But that's a good question. I probably have a different answer if I thought about it a little longer.
Yeah, no, that's a great point. Someone said, everyone's a genius in a bull market, right? Which spoke to your earlier point about nobody is unhappy with their advisor now because things are great. But tomorrow when things turn around, then all of a sudden the world changes like that. Okay, so the final question, I guess, for you, Ed, what's the best piece of advice that you've ever received on or off Wall Street?
It's funny because before my father passed away, I asked him a question because I said, because people always say, oh, my dad always told me this, my dad always told me that. And my father never really gave me any lessons. And he did say one thing. He said, save your money. Mm-hmm. And I didn't do a really good job and haven't done a great job at that. But I think people who have to make transactions, which I don't have to do, people who are forced to do things in business, money blinds you to rational thinking. And I don't have that problem. And so a great lesson would be to make sure that you're always doing what's right for the client and learning about the industry. Because most of the big firms like Morgan Stanley, which I grew up at and talked at their training programs, UBS, Merrill Lynch, don't teach portfolio management. So you have to go out on your own to really understand asset management. So, anybody out there who's watching this, who has an advisor who doesn't know about the 8 metrics, they should know about those, because those are metrics that are really at the heart of what portfolio management's all about. And that's why I created those 8 metrics. Wow. So the lesson would be to really, think things through and don't have outside forces make you have to do anything, and just do what's right for your client.
That's a really, 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 really good lesson. So you did open, I have another question because you prompted, pinball's going on inside my head, if you don't mind. Portfolio management, what does that mean for somebody who's not aware? And what are some lessons you've learned about portfolio management?
Well, for somebody who doesn't know what a portfolio is, it's taking, all of the assets that you have that are publicly traded or privately traded and analyzing how they work together and what you should expect from this collection of investments that your advisor gave you. So if your advisor gave you this collection of mutual funds and bonds and preferreds, how do they work together? What should the benefit of it be? And that's what portfolio management's all about. And what we do is we analyze those first, and then we come back and show how to do it properly. And again, as I stated earlier, 97.5% of all retail portfolios take on too much risk for the expected return. So portfolio management is really looking at everything that you have, including your cash flow, to make sure that you have enough money to live off of if you're in retirement. And you should always make sure that it's about 6% more each year, because that's what your true cost of living increase is.
Got it. Even though inflation or CPI is 2% or the Fed's target is 2%, but in reality, I agree with you 100%. It's 6 or more. So, okay, final question. I have a book coming out. It's titled Psychological Analysis. In addition to fundamental and technical, I have a third school of thought called psychological analysis. You spoke about emotions and decision-making and emotions and money. So it's, again, the pinball was going off. Can you speak to the psychology of investing, and what are some lessons you've learned there, if you will, both from a professional standpoint and individual standpoint?
Yeah, well, from an individual standpoint as well. I'm a neurotic Jew, and I will tell you that the idea of staying in when the market is very expensive is very, very difficult. Right now, the market, is about 35% overvalued based on expected earnings, but it continues to go higher. So there's a psychology about when to get out, and people expect us to know exactly when to get out, but then also expect you to move up with the market. And so the psychology for clients, and including myself, is, being a nervous Nilly and wondering and worrying about every move in the market. And they have these phones that 24/7, they're getting, stock market updates and portfolios. I have clients that, literally will say, well, I was down, $89,431 today. I'm like, okay, well, then you have to talk about the percentage that the market was down and prove to them that they were down only half of what the market was down, and that your non-correlation is working. But the psychology is really a big deal when it comes to the individual investor. But psychology, I will tell you this, Adam, for your book, has very little to do with the moves in the market, because 98% of the market is moved by institutions. It's not moved by individual investors. So the idea that an individual investor wanted to get out of the market is not moving this market. Individuals don't move the market.
Yeah. Do you think the big institutions have psychology also that impact their decisions?
I think to some degree they do, but I think that a lot of it is done by computers. And if they hit different technical trading points, there's sell programs that kick in.
Right.
But a lot of it are big institutions that have a different mindset than we do as individuals.
Well, Ed, this has been absolutely brilliant. Thank you so much for coming on the show, and hopefully we'll speak to you again soon.
Well, thank you very much, and good luck on your book.
Thank you so much.